reading this the other day, I felt like this was Chinese. Like, I don't know why. I just, with all these trades right here, it didn't really make much sense to me. But now I was reading it, I understand, like, all right, these are like, so I'm just going to say, you stop me when I'm wrong, but I'm just going to tell you my thought process. I looked at 932 0DT AIA put side $2, and then there's also a call side $1.20. Are these two connected? And this is one trade, and this the low premium and the low premium, that's another two trades, right? But they're not connected. These are the only two that are connected, right?
Correct. And I know it's kind of confusing, but it's like they are two separate trades, but they use the same buying power. You know what I'm saying? So like you could see their P&L. They're managed completely separate. They are two separate trades.
Yep.
Yeah, but they in turn use the same buying power. So they're paired. They're two separate trades paired with one another.
All right, they're two separate trades. All right, so yeah, these are two. Is this a condor? Is my question.
It's a condor, but it's managed individually as vertical.
Yes.
Yes.
So it's a condor, but this is managed as the put side, and this is managed as the call side, correct?
Correct.
All right. All right. So going into this, I haven't put it into groups yet in option omega. You already answered one of my questions. So we are going to group this.
And this is why you're named the same. You know what I'm saying?
Yep.
932 AAO, but we distinguish them call and put.
Perfect. All right. That makes sense. Yeah. I remember you showing me that. So I was going to ask that. So did I enter? So I'm trying to do a year to date. So I just did 1/1/2020 to now 2024.
That's not year to date, but yeah.
So would it be six?
Yeah, just click year to date, YTD up top, and it'll automatically populate it. Yeah, there you go.
Oh, I thought it was I thought you had to put start date as 2020 for year to date.
That's how we do backtest to like long dated, but so we don't have to wait 120 seconds on the call. We'll just run a shorter period. You know what I'm saying?
I see what you're saying.
That's why I sent you the trade automation toolbox thing, because it gives you the results like that.
All right. Makes sense. All right. So I did XPX as a ticker, of course.
Yep.
Iron Condor, fixed premium. That's all looks good, right?
Correct. Yep.
I get the sell put $2, 0DT. Buy put, again, all one quantity, 100 wide, so 10, correct?
Yeah. And then we also want those green locks to be unlocked, because that means it will only take it at 100 wide. You know what I'm saying?
All right, makes sense.
And also where you've been able to stay here is the width of that spread is going to be points. So it's not 10 points wide. It's 100. It's 10 grand of risk, not one.
So it's 100?
Yeah. And if you look at the trade steward, it shows that.
100 wide. Yep. All right. I thought it times it by 10 on this. That's why I guess I was guessing.
Well, 100 is times by 10. It's $10,000 buying.
All right. See what you're saying.
You're taking $200 of premium, 2 times 100. You're using $10,000 of buying power. 100 times 10, 10,000. I mean, 100 times 100, 10,000.
Yep. Makes sense. And then, so same thing for here, 120 put side, because I was looking at.
And you did good on the minus and the plus, so you remember that.
Yep. And 75 that you corrected I had it at 7.5, but you corrected it. So 75. Everything looks good there, correct?
Yep.
All right. So this is where I was getting the concept of that. I get the 50,000 starting funds. Do we do 100% margin?
Okay, so we're doing 100% margin, but we're going to override it with our contract size. So like if we did 10% margin, it wouldn't trade 2 trades, or if like we took a loss or 2 during the back test, it may flip from 1 trade to 2 trade. You know what I'm saying? So like in Trade Steward, how many contracts are we trading for this trade?
2.
So that means
50%.
You're going to want that 100% margin, but you're going to put max contracts per trade at 2. And what this does is if we go down 10 grand or up 10 grand, it won't make it a 3 lot or bring it down to 1 lot. So we'll get the consistent time results.
All right. See, I put the 2 contracts in there before, but I didn't understand.
Go back to the margin thing. So like if this is a 50 grand account and we were using 100% of our account, how many contracts will we actually be trading?
1 contract.
If we
Right.
use 100% of 50 grand, how much buying power do we use per trade?
Oh, I see what you're saying.
If you
Yeah,
use
it would be.
5, and then if we
Yeah,
went on a winning streak and we got to 60 grand, it would start selling 6 contracts. If we
yeah.
went on a losing streak and dropped below 50, it would start selling 4 contracts, which then would have different size. We'd sell 6 one day, 4 one day. So now our results are different because we're trading bigger on different days.
Oh, all right. So if I had 0 here, this would be 5 contracts. This is automatically saying I'm doing 5 contracts. But
And then
since
if you lost, it would go to 4, and if you won and got to 60 grand, it would go to 6.
oh, all right, makes sense. So now that I
we're
have,
just trying to do fixed contracts, but we use the 100% margin because we know we'll have more than enough buying power, no matter what our drawdown is, to do 2 contracts.
all right, makes sense. So the 2 contracts saved us for losing a crap ton, basically.
Mm-hmm.
All right.
Well, it just makes sure we're trading the same size every day, so our numbers will be accurate.
Makes sense. Makes sense. Makes a little sense. So like if this is 0, right? I'm trying to just understand this at the level you're saying. If this is 0, or not even, I just don't put anything in here. Let's not say 0. I don't put anything in there. This would, it could go up by 5 contracts or go down.
It would start at 5 contracts. If we got to 60 grand, it would start trading 6 contracts. If we lost to 40 grand, it would start trading 4 contracts.
But now that I put 2 in here, what does that do?
It's just always going to trade 2, whether we have a 200 grand account or a 30 grand account.
Makes sense.
Yeah.
All right. Makes sense. Awesome. So 932.
So the key concept is we're just always going to override it. That's our fixed contract, what we're actually trading in that account, because we want to know what our actual risk is with what we're currently doing.
All right. Sounds good. That sounds good. All right. So 932. That's pretty. No float or anything daily. It said it on the thing. This is the other thing. I know we always do intraday. No, do I do any of this?
You're going to use the VIX because we have the VIX up or down filter, right?
That's where I was trying to find. So where's the VIX up or down on this one?
Trade 932 0DT AIAO.
Click on it.
Yeah, click on it. Now scroll all the way down to the bottom.
Oh, all right. Sweet. All right. This is where I was missing the data then. All right. This makes more sense.
Scroll all the way down, scroll all the way down, scroll all the way down. See?
Yep. Intraday greater than.
Yeah.
Awesome.
Now program that. And
so this was overnight gap. Overnight move. So that's gonna be the max overnight move. Greater than. So I'm trying to reverse this because I've remembered.
If it's max down, what does the max overnight move down mean? That means that if it's more than that number, would we execute the trade or not?
If it's more than that number, if it's great, so if it's more than that number, we wouldn't. If it's less than that number, we would, right? Like if it's -1, we would, but if it's -3, we wouldn't, right?
No, because what's greater than -2.5?
-1.
No.
-0.1. My bad, is what I meant.
No, -0.1 is less than -0.25.
Why do I always F this up?
What's closer to 0? -1 or 1?
What's closer to 0, -1 or 1? They're the same distance.
In regards to the -0.25, you know what I'm saying? So if -0.25.
Now I'm screwed because
so if you think about it, if you're -1, -1 is a smaller number than -0.25.
Yeah.
Okay. So if you're looking for, we're going to execute this trade if the overnight move is greater than -0.25.
Oh, so
write it out. Is -0.4 greater than -0.25?
No.
Is 0.5 greater than -0.25?
No. Only -0.1 would be, right?
No, because -0.1 is a smaller number. It's further away from 0 than -0.25. You know what I'm saying?
Yeah.
So what greater than means for a negative number is anything closer to 0 than that number.
So negative 0.20 would be closer, right?
Correct. But negative 0.3 would be further away than negative 0.25 from 0. So we would not trade it.
All right. So wouldn't negative 0.10 be closer to 0?
Yeah,
Like
negative 0.1, not negative 1.
That's what I was trying to say.
Okay. And just to take a step back here, are we clarifying the numbers part, or are we trying to clarify we're confused by the greater than min max gap?
At first, I was trying to clarify the overnight, and then the numbers were getting. We're good on the numbers now.
Okay, numbers. Okay, so now this is going to be confusing. So on Trade Steward, we have drawn the line of we will trade this if it's closer to 0 than negative 0.25.
Yes.
So if we go to Options Omega now, we can see that which one of these barometers is going to set the fact that we're closer to 0 than minus 0.25.
It would be overnight move up, right?
It's going to be the max overnight move down. So that means if we put negative 0.25 in the max left overnight move down, just put 0.25. They don't take negatives here. So if the max move down is 0.25, because since it's down, that makes it the negative in Options Omega.
Makes sense. Yeah. That's where I was getting confused at.
So we've drawn the line minus 0.25. That's the max down. Anything above that, max down, minus 0.25. Max down, minus 0.25. So anything above that, we were trading it.
Yep.
So basically, this is the minus 0.25, anything closer to 0.
Makes sense.
All right.
Yeah, that makes sense. Awesome. So we're good on that. Let me make sure. And then is it we always do the not intraday movement. I got that confused with something else.
Now you have your stop loss, which is correct.
Yep.
You have your national bid best offer only. That's what NBBO stands for, national bid best offer. So that's correct.
We're doing leg groups though, right?
Yep.
So, and you just got to do the put side and the call side. Group name, put, and then call. And then, so we're going to go here, and then so.
Yep. But now you need to scroll down and put a stop in for the call side or the put side, whichever's not showing.
Where do I do that at?
So keep scrolling. So your put side's already correct because you already have. Here's the call side.
All right, let me see what it said in.
This is the put side, so you'll have to go
back. So all right, call side was another 400%, right?
Yep.
Awesome. Is it this? Do I need to do this again?
Yep. You're always going to be intermittent. Bid best offer minus. Scroll down. Now exits, nothing. MISC. We paid a trade, so we got to account for it.
Yeah. So on the commissions and fees, all right. Go ahead.
That's a fixed cost. That's how much the SIBO charges us a buck.
Yeah. So how much is it on the commissions and fees? I couldn't remember.
$1. It's always $1.
Commissions is always $1. All right. I need to write that down. $1. That's one thing I forgot. Do I need to do it per or this?
Yeah, both per contract because you pay to get in and get in. Okay, so this is now the important part. Use slippage.
Yep.
Okay, so this is probably going to confuse you. So the entry slippage, if you scroll up, so you can see here, scroll up all the way. So when we get in, we're shopping a 2-leg order because we're selling the short and buying long. We're selling. Yep. So usually the bid ask is a minimum of 5 cents. The SPX is liquid. This is great. So when we're shopping a 2-leg order, it's going to cost 10 cents to get in.
All right.
So go down to the slippage, entry slippage.
Yep. Hold on. I'm just putting this down. Cost 10 cents. All right. And let me get down here.
And that's conservative. It's probably closer to 5, but.
So it cost 10 cents to get in.
Yep. And then stop loss slippage, which is important.
Is it gonna be
scroll up? Okay, so when we get out of this trade, we're only going to be managing the short leg because remember the long leg's dead to us once we enter.
Yeah.
So with this short leg, if we look at the put, it's only $2 right now when we enter. However, when we exit, what's the stop loss on that $2?
Is it 0.8? Is it the difference between these two?
What's our stop loss for the put side?
Stop loss is 400%.
Okay, so if we're 4 times the value of $2, what is that? 800.
800, yep.
800 because it's $2. But and the other thing you need to remember is it's what's called a net loss. So if it's a 4x loss, we've lost $800. However, we entered the trade for $2, so we're actually buying back the contract at $1,000. Does that make sense?
So say that one more time.
So if we have a 400% loss, we're losing $800.
Yeah.
However, we collected $2 to open a trade, so we're losing $800 more than $2. You know what I'm saying? So
yeah, that makes sense.
When we buy it back, our option's actually going to cost
$1,000 because the difference between the 200 plus the 800.
Yep. And then our rule of thumb is 2.5% ish, but we'll just put 20 cents.
All right.
So let's do this real quick. On a $2 option, how much are we buying the option back for if we have a 4x loss?
$1,000.
Correct. And what around 2%? What would our exit slippage be for $1,000 contract?
That's where all right. So redo that. That is where I got confused. I get the 800.
You have a $200 thing of premium. You have a 4x loss, so you're losing $800. So now
it'd be 800 would be the exit slippage.
No. So we're buying. So we sold $200. We lost $800. However, we also collected $200. So it's going to cost us $1,000 at our stop loss.
Yes.
And it cost us roughly 2% of that $1,000 in exit slippage. So let's do this again. $2 option. That is a 4x stop. How much money do you lose on it?
800. And
how much money is the option going to? Okay. Now what's 2% of 1,000?
2% of 1,000. That's freaking like $20. Yeah.
So if we scroll down, and this is back to times by 100. So our exit slippage on the put side, or exit slippage, you just use $20. $20.
All right. I see what you're saying.
20 cents because it's times by 100.
Oh, 26. My bad. Yep.
Okay. Now, if we scroll back up, look at the call side. So if you're collecting $1.20 and you times that by 4, what is that?
Yeah.
Use a calculator. Yeah, roughly. Okay. Yeah. It's like $500. Now, 500 plus $1.20. So it's like $620.
Yep.
Now, repeat that. Now, run me through it out loud, what I just told you.
So, since it's $1.20, our stop loss would be, times that by 4 as well. That's roughly $500. And then so on that one, how did you get 600 out of that? That's where I'm confused.
So you're taking 480, 120 times 4. That's how much money you lose.
All right, 120 times 4. All right, 480.
You collected 120. So what's 480 plus 120?
Plus 120, 600. All right.
600. So now 600 times what percent is going to be our slippage?
600 times so 2% again. All right.
So how much is that?
600 times 2% is freaking let me do the math on that. But
if 1,000 was 20 cents, 600 is going to be 12, right?
Yeah, you're good at math.
Yeah, whatever. But if you scroll down, that's not.
It'll be 0.12 then.
Yeah, but if you scroll down, we can only use one slippage on this, so we're just going to use 20.
All right, sounds good.
Yeah. Now
the stop loss always always overrides the exit slippage, right?
We're not exiting this trade. Yeah, But
if we were to even put exit slippage, that's just the theory of like this.
If we get stopped out, which is the 400%, it's going to take $20 away from us. If we exited, it would take nothing on this trade. We're not exiting, so it's irrelevant.
All right, sounds good.
And the other thing, the last thing you want to do here is see capped non-operating losses at stop loss. Click that. And basically what this does is if the price were to jump from $980 to $1,020, it would just take the $1,000 stop and add 20 cents to it rather than taking the 1020 stop and adding 20 cents to it. Does that make sense?
Yeah.
Because in real life, the market can jump, but we're gonna, since we've already beat up the stop loss, we're just assuming that when the trade triggers at $10, it's going to send our order through and we'll just lose 20 cents, which over the long term will be true, but just not on a day-to-day basis.
Makes sense.
Okay, now run the test. Okay, now save this test. Damn, this trade's been banging this year. Now NVIDIA's got nothing on us, dude. Now,
yes.
Do you remember how to save this?
Do I just say save right there and then
Click Connor LTR?
Oh yeah, Connor LTR, and this would be
title this Connor,
year to date.
Yeah, YTD AIAO full condor or something. And then maybe like title it like I did this one so you know which one it is. Okay, so now you're good.
And now do I need to take this though? Like
So save it now in Option Omega, save. And then actually re-click the notepad. Scroll all the way to the bottom. Share test with others. Save. Now go to the paperclip and option left paperclip.
Oh my bad.
All the way to the left by the title of it. Yep, you copied it. Now go to Trade Steward.
And click on this.
Yep.
And go all the way down.
Way down. Erase that, what you have in there. Paste the link. And then write, this is the test I use to monitor day-to-day performance. And then go back to Options Omega. And then click New Backtest. And then go 01/01/2020. Now run it. And then once this one runs, you'll save this one as this is my long-term expected result from this trade, and you'll save it in the same area on it. So basically,
we'll have two different ones to look at.
Yeah, like you won't need to do it because I already did it, but basically like the long-term expected result is like the back testing that we do. And then once we run it, since we've decided to run it, we already know it has a good return. So now we're just monitoring it to make sure it matches every day. You know what I'm saying?
Yeah. Can I ask you one thing? I get that. Can I ask you one thing on the slippage one more time? Is it normally, where did you get that 2% number again?
That's just like a beat up thought of how much the slippage will be.
About 2% usually.
Yeah. Like it'll be volatile, like you make it 30 cents, 5 cents, but on average, it's going to be around 2%. Now save this.
Sounds good.
And save this.
On average. Sorry, I'm just writing that down. On average. And then save this bad boy. And then just going to say this is going to be.
You're going to create new because you'd override it.
Oh, yeah. Create new back. That's my bad.
Just saying all-time expected return. And then save it under Connor LTR and make it link shareable.
And then bam.
And then write, this is my long-term expected result.
Like, can I enter it down here or is it not going to let me? I'm trying to hit enter.
No, that's why I just put 3 hashes and then do it.
Oh, all right.
Put space, 3 hashes, space, and then do it. And then also this may be confusing, but it's like, this is going to show you the put and the call simultaneously. So if you wanted to, you could link just the put side because that's what this side is going to be.
No, yeah, that makes sense.
But